Thanks, Oliver.
So we're looking at what appears to be a pretty quick little move here in 10-year yields over the past week, basically. What does it mean, Kathy? Should investors be reassessing their kind of ideas of how quickly this thing can move or how far it could go over the next year? What's going on here?
Yeah, it's been a pretty rapid move. We came into the year expecting about 1.6 on the 10-year, and we're already at 138, 140 today. So it has moved very quickly. But I don't think it requires a reassessment. I mean, we've all known that once you get the vaccine rolled out, you start to get economic activity back up, that there would be expectations for stronger growth and inflation, and none of that's changed. I think what's really changed is it just happened more quickly than people expected, and they've hopped on board. But I don't know that we're going to go a lot above 160, 65 or so, just because we need to have the real economic data catch up with the market. And we also need to see the details of the fiscal stimulus package, because much of this run-up has to do with expectations for more fiscal stimulus from the federal government.
It seems like the stimulus point is a really important one right now, where we've been focused and excited, I think rightfully so, about the organic developments happening or the scientific developments from J&J and the vaccine rollout going pretty smooth. But to your point here, I mean, the whole kind of move started with the idea of stimulus, and that's kind of fallen back to the wayside, at least from what I can tell in the narrative. What do you see, Kathy, in terms of how those expectations about stimulus have changed? I mean, is there a price tag, a dollar amount that the 10-year yield needs to stay at 1.4 right now?
Yeah, I think we need to see at least $1 trillion package. I mean, that's half of what the Biden administration has proposed. So we need at least half that amount, I think, to get through Congress and get through fairly quickly to justify the run-up that we've seen in yields. Otherwise, if it's a smaller package, slower rollout of the package, then we're looking at some of the benefits, the unemployment compensation, supplemental benefits that have been put into place for people affected by the pandemic. Those are going to run out in about 2-3 weeks. So we really need to see the follow through and then see that come into spending in the economy to justify where we are in terms of our projections for economic growth.
How does it combine with what we're seeing on the virus fight and the progress being made there? Kathy, I would guess that trillion you talk about, I mean, the rumor for $2 trillion, that some of that's at least got to be already priced in here, right? To where, you'd think, okay, if we don't get it, to your point, then, yields drop. What if we do get it and then we're questioning what comes next? How do we analyze what's important as a contributor to the higher yield environment in terms of organic versus stimulus, i.e., do we need more stimulus after this? Or if we just get the vaccines out and see natural recovery, do we assume the yield keeps running on that alone?
Yeah, well, this is where the debate is in Washington. So some would say, let's just do enough to get through now until the vaccines are rolled out and then reassess. Others are saying, look, this is the opportunity to not only, fill the gap that's been created, but actually move above that, or fill the hole and continue down the road or build a road. So there's talk about infrastructure spending and a lot of longer-term investments. And so that's the debate in Washington that's going on right now. But I think we need at least $1 trillion to justify where we are today, and anything beyond that could lift rates further. The other thing we need to see, though, is lower unemployment or higher employment, as Jay Powell would say. The loss of 9 to 10 million jobs that's still out there is a big concern for the Fed, and that's going to be a drag on economic growth. And so we need to start to see that number improve considerably from where it is right now.
In terms of what Jay Powell is talking about today, a lot of the same, right? Not going to hike inflation. They're going to let really prove itself to them. Maybe it'll take years, to paraphrase the chair. He talked about asset prices being elevated by some measurements. I think one could definitely dispute that, but that's not our subject here. In terms of the employment situation, what jumps out to you, Kathy, about what the chair has talked about and what we should be looking for to understand what he's going to do?
Yeah, I think from the Fed's point of view, we've heard from both Powell and Clarita and Lil Brainerd that they're looking for the job market to get back to full employment. And that's not just a low unemployment rate, but that's actually getting the employment to population ratio back up. So if you look at where prime age workers were prior to prime age, meaning 25 to 54, people are out of school before retirement, that was up to 81%. That participation rate was really high. It had been the highest in decades, and wages were growing at a little over 3%. I think that's the sweet spot that for the Fed to look at and say, that's full employment. That's where people who've been out of the labor market are starting to come in because there's a lot of jobs available. You get people on the ladder to employment in the longer term, and that's inclusive employment, which they talk a lot about. So this is the metric I'm keeping an eye on, is how's that employment to population ratio going, especially for those prime age workers, because I think that's the ratio that the Fed is most focused on.
So we've clearly got a lot of space between here and where we were pre-COVID, and the idea that maybe we could push it even further from that. All of that adds up to an understanding that Mr. Powell and team are not eager to hike rates, right? It's clear. Everybody knows it. They keep hammering it in. But Kathy, what about the relationship between the long end of the market that we're talking about for 10 years plus, I mean, even 5 years too started to move a little bit as well, versus that short end? Because the short end's generally been anchored because the market believes Powell. But for investors, is there a risk to assuming that no rate hikes, means no liftoff in yield? It seems like we're learning that that can still happen.
Sure, and it is pretty typical in a cycle for the long end to lead as economic growth picks up. That is it's kind of a normal cycle, and then you don't crest in the long end until the Fed starts hiking, and then the curve starts to flatten. I think we're a ways from that, and so it's pretty normal to see the curve steepen like this. And I think there is a risk that the Fed gets challenged on their patient point of view. So if we start to see long rates move up a lot, if we start to see inflation expectations pick up more, maybe some negative impact in risk markets as those rates move up, tightening financial conditions, then the Fed has some tough choices to make at that stage of the game. But right now, things are going along okay, and we should expect the long end to continue to lead the way until we get closer to an actual rate hike from the Fed.